Good evening and welcome to the November 8th edition of Office Hours presented by the Maryland Center for Collegiate Financial Wellness. My name is Dr. Tisa Silver-Kennedy and I'm the founder and executive director of the center, and I thank you so much for joining me for this evening's edition. If you'll bear with me for just one moment, I'm going to go ahead and share my screen so that I can tell you a bit about the center, also a bit about office hours, and then we will dive into the many questions that have been submitted from members of our community. All right. And all right, there we go. So again, this is office hours. I'm going to tell you about the Maryland Center for Collegiate Financial Wellness, about the program you're attending right now, which is office hours, and then we'll head into questions. So the Maryland Center for Collegiate Financial Wellness was founded in 2021 with an ambitious vision for all college and career school students in the state of Maryland. And that vision is that all of these students have the opportunity to achieve these 6 pillars of collegiate financial wellness. That's being creditworthy, ready, resilient, empowered, successful, and thriving. To learn more about our mission and vision, as well as the organization and our programs, you can visit us online at mccfw.org. And if this sounds like something you would like to support, you can also go to the support page at mccfw.org and look for the different ways that you can be a part of our community, whether that's through financial support, social media support, or otherwise. As for office hours is our free semi-monthly virtual student loan clinic that provides borrowers with a trusted venue to help them navigate student loans and prepare for financial success beyond repayment. I must share a disclaimer with you, though, and that's that office hours is presented for informational purposes only. We do our best to provide you with the most up-to-date information possible, but if you've been paying attention to office hours, you know that there are a lot of moving parts and things have been changing frequently and sometimes very quickly. So we do our best to provide you with the most up-to-date, accurate information, but we also advise that you take into account the information you hear during programs like this, but also take an inventory of your loans, your personal finances, and also contact your lender before you make any decisions about your student loan repayment journey. So, with that being said, it's time for us to share some updates. First, I want to start out with a recent PSLF victory. This is for a longtime state of Maryland employee, that is, who recently had more than $99,000 forgiven by way of public service loan forgiveness. And they said, thanks, this is because of you. Thank you for convincing me to do it. And I must say, it was kind of like twisting an arm with this person sometimes, because like many others, there are some gaps in repayment. And a lot of people are under the impression that they had to have made payments on the right repayment plan the entire time to get to that 120 qualifying payment milestone. So for this person, there were some gaps in payments, but I kept on saying, just fill out the paperwork and let's see what the count is. And finally, they consolidated their loans, filled out the PSLF application, and now all of their student loan debt is gone. So I'm very happy to be a part of that victory, and will continue to do my best to convince more people to apply for public service loan forgiveness. All right, now we've got some updates in terms of events that are coming up. For the center, we have a webinar coming up through the No More O Less project, and that webinar is entitled Loan Forgiveness for Educators. Even though we're focusing on educators because that's the population that is served by this particular project, No More O Less, the webinar itself is open to all. It's useful for people who are public servants as well as those who are not public servants but have lengthy loan histories. We're going to be talking about public service loan forgiveness, the IDR Adjustment, and pathways to cancellation. That webinar is happening next week on November the 14th at 6:30 p.m. Eastern Time, and you can register online at mccfw.org/KMOL, and that stands for No More O Less. Also, the Maryland Higher Education Commission is hosting a virtual financial aid open house on this Friday, November the 10th. There's no registration required. You can watch this event on YouTube if you go to the account of the user that's listed on the screen. And I encourage you to join if you are thinking about higher education and wondering how to pay for it, wondering which aid programs you might be eligible for, especially at the state level, because MHEC awards, I believe, more than $100 million in state scholarships and grants. So please do join MHEC for that virtual financial aid open house on Friday, November the 10th at noon. And again, there's no registration. You can just hop onto YouTube and watch the broadcast. All right, so we've got another update. This is on the pace of my application for public service loan forgiveness. We are at day 54. So we've had action since the last episode of Office Hours. Just before that episode, toward the end of October, I saw the update that my loans have moved from Nelnet to MOHELA. I also saw that the payment date was November the 9th, and that happens to be my birthday. So I was not very pleased to have my student loan payment due on that day. But anyway, not long after that, I logged back into studentaid.gov and I saw, of course, MOHELA is still my servicer, but the payment date had moved to December 9th. So I thought, oh, maybe I'll have a break this month. But it's best to go to your servicer's website to look for an accurate due date, because the servicer is your point of contact for making payments. So when I logged into MOHELA, I saw that the payment due date was in fact November the 9th. So I made my payment today, so I don't have to make it on my birthday tomorrow. All right, something else that I noticed when I logged into MOHELA, I wanted to know about my qualifying payment count. And if you have submitted a PSLF application and you're wondering if you have a payment count, you can log into MOHELA's website, set up your online account. And then there's a kind of like a dark blue horizontal navigation bar toward the top. And you'll see PSLF on that nav bar. And if you click the little arrow next to PSLF, you'll see a drop-down menu of choices. The payment tracker should be there. Sometimes right after your loans have moved to MOHELA, the payment tracker isn't available right away. But if it becomes available, you want to click on that so that you can view your qualifying payment count. You can also view your ineligible payments, eligible payments, and employers. So when I looked at my qualifying payment count, I've got the image that you see at the top. That is 2 payments out of the 120 that are required to have the total amount of the remaining debt forgiven by way of PSLF. So with 2 months, I'm very early into this journey here with another 118 months to go. But that might not be the case for you. You might see a qualifying payment count, but you could still have more months that could end up counting depending on your employment verification. So I always encourage people, don't stop with the qualifying payment count. Click on where it says show payment summary so you can get all of the numbers. You can see your eligible payments versus your qualifying payments. So if you take a look at my loans there, for eligible payments, I have 61. That's basically 5 years of months that could qualify toward PSLF. However, I only have 2 months that actually qualify. That means there are another 59 that need employment certification. Now, for a lot of people that I have worked with, they have been career public servants. So when they see a gap like this, they know right away that some of their employment history is missing. For me, I've been a public servant for most of my career. However, right after my loans went into repayment is when I started my own consulting company, which was technically a for-profit, even though my clients, for the most part, probably 90% of my clients are nonprofit organizations. So I've worked in support of nonprofit organizations, but because I was not a direct employee of those organizations, none of that employment counts. So this qualifying payment count of 2 is actually accurate for me. I officially became a nonprofit employee in July. I submitted the PSLF application in September. So I have 2 months that qualify, and the other 59, unfortunately for me, do not qualify for public service loan forgiveness. So I hope that you all who are applying for PSLF will definitely go to MOHELA.com, make sure that you set up your account. And if you see a qualifying payment count that's not 120 and you believe, the count should be higher, click on that show payment summary so that you can drill down into the details. And when you look at that payment summary there, where you have the eligible payments versus the qualifying payments, remember, the only difference between a payment that's eligible and a payment that's qualifying is your documented work history. So if you know that you have, the qualifying employment for the entire time, the only thing that's standing in the way of converting those eligible payments over to qualifying payments is verification of your employment. So if you need employment verified, you want to make sure you go to studentaid.gov/PSLF and complete the PSLF application online. All right. So one more thing I noticed, and this is not about my PSLF application, this is just about my payments in general. So you all know the payment pause ended August 31st of 2023. Interest began to accrue again in September, and payments were due in October. So my first payment was due. I think it was $281 it was due. I actually paid $350. So when I went online to make my November payment, I saw that the amount was $193 and some change. I decided to pay $300. I've heard about this before, but I don't recall having experienced it myself. That's when you make a payment that's above and beyond the required payment, the next month's payment is actually lower. And this is something that if you're not paying attention to it, it could make it so that even if you're paying extra, those extra payments won't really benefit you, because with a normal debt, if you choose to make payments that are larger than what is required of you, then you attack more of the outstanding interest. And if you covered all the interest, then you begin to chip away at the principal balance, which is what I'd like to do. But in the month following the month where you've made the extra payment, in that following month, if the payment has been decreased because of the fact that you paid extra in the prior month, then you're basically going to be at the same place if you pay the amount due that's listed. So I definitely don't want to do that. I want to pay this down. I don't want to say aggressively, but I want to pay more than what's due so that I can get rid of this debt faster than the timeline that's been laid out for me. Now, I know some of you will hear that and say, well, wait a minute, you applied for PSLF. Don't you want to, wait for that? I'm doing the math, and it looks like PSLF is not going to help me because of the fact that I have those basically 5 years of eligible payments that are never going to convert. And I have been paying on this 10-year standard plan prior to the pandemic. So with another 118 months necessary and a relatively low balance compared to earnings, it just would make more sense for me to just pay down the debt. And so that's what I'm going about doing. But for those of you who want to pay extra on your student loans, you can do that. There is no prepayment penalty on federal student loans. But when you do pay extra, you might want to, after you satisfy the payment that's due, go into your portal online and select which loans you want to target if you have the option there. And perhaps you want to target the ones that have the highest interest rate, the highest balance, or maybe you want to use the snowball method and get rid of the smallest debts first. Totally up to you. But if you're paying extra and you have the choice to decide where those extra funds go, take a look at that and make those decisions based on what's most important to you. All right, so now let's get into the questions from our community. First question is, for PSLF, do the months during the COVID pause when no payments were made qualify for PSLF, even though no payments were made? So the heart of this question is, which months count toward PSLF? So first, the months during the CARES Act Forbearance can qualify toward PSLF with verified qualifying employment. So if you have if you know that you have the qualifying employment throughout that CARES Act forbearance and your loans were included in the forbearance, then all of that time can qualify toward PSLF. Now, the CARES Act forbearance went into effect March 13th of 2020, and lasted until August 31st of 2023. In September of 2023, loans went into an administrative forbearance. And because that was not a forbearance of our choosing, that time can count toward PSLF as well, as long as you have that documented employment. It's important to remember, though, for PSLF, it takes two things: the employment and the repayment history. So if you have the employment, and your loans would have been in repayment had that CARES Act forbearance been enacted. If you have that period of overlap, then all of that time can count toward PSLF, but it's only going to count if you complete the application at studentaid.gov/PSLF. All right, so a little bit more about which months can count. Credit can also be earned through the one-time IDR adjustment, but the credit toward PSLF depends on your loan types. So direct loans qualify for PSLF. Therefore, any payments that you made while working for a qualifying employer after October 1st of 2007, regardless of the payment plan you were enrolled in, will count toward PSLF. So the credit that you earn through the IDR adjustment, it counts toward IDR cancellation, but if you have the documented employment, those credits can basically be transferred or also applied to public service loan forgiveness. If you have non-direct but ed-held loans, these would be like FELP loans that are federally held. Those loans were included in the payment pause, and they're also going to be included in the IDR adjustment. However, if you want them to be considered for public service loan forgiveness, you have to consolidate them. With PSLF, there is no consideration for any loans other than direct loans. You can get non-direct loans on track, but they will not be considered until after they have been consolidated into the direct loan program, and that is strictly through studentaid.gov, consolidating with the federal government, not a private lender. Now, for commercially held loans, these are federal student loans, but they are held by these non-government lenders, such as you might see Navient. That's one that I see a lot. Sometimes I've seen, I believe, Wells Fargo or Truist. If you see a balance within studentaid.gov, but the loan is not direct and it's not a federally held FELP loan, then it's commercially held. Commercially held loans are not going to be included in the IDR adjustment. They were not included in the payment pause, but they can become eligible for PSLF only through consolidation. And again, that consolidation takes place by completing the application at studentaid.gov. There's also a paper application which can prove useful for some people, but for most, I recommend completing the application online at studentaid.gov. All right, let's move on to our next question. I heard about the SAVE repayment plan and its benefits. I heard that I could maximize its benefits by declining my unsubsidized loan, borrowing Graduate Plus loans, declining my in-school deferment, and beginning repayment. Will this work? Oh, I wish I had a crystal ball. Okay, so first we're going to, I want to take a step back and kind of unpack this question and just talk about how this is possible. So the person is referring to two types of loans, direct unsubsidized loans. Some of you might hear these referred to as Stafford loans, but direct unsubsidized loans, that's the first type. The second type is PLUS loans for graduate students, and these are two different loan programs. So direct subsidized or unsubsidized loans, these are loans that have an in-school status. That means that while the borrower is in school, those loans are not in repayment. The in-school status is something that is mandatory, so there's no way to get out of it. On the other hand, PLUS loans have an in-school deferment, which happens automatically as long as the borrower is enrolled at least half time. So 6 credits for an academic term will push the loans into an in-school deferment. However, there is the option for the borrower to basically opt out of the in-school deferment. So the PLUS loans can be allowed to go into repayment. So if a borrower is trying to take advantage of SAVE, what they would want to do is decline all of their direct unsubsidized loans. And this is specifically for a graduate student. They would decline all of their unsubsidized loans. And instead of taking the unsubsidized loans first, they would not take any of them and accept all plus loans. So they would use plus loans to cover anything that's not covered by, a scholarship, a grant, or an out-of-pocket contribution. So the only type of loan they would take would be the direct plus loans, and those can be borrowed up to the cost of attendance. Then, once those plus loans have been dispersed, the student can opt out of the in-school deferments, and technically the loans should enter repayment. If the loans enter repayment, they'll begin to accrue interest. Now, interest accrual is something that you can't get around on an unsubsidized loan, and direct plus loans are unsubsidized loans. There are different kind of variety of unsubsidized loans, but the word unsubsidized means that the borrower is responsible for the interest. There is no subsidy coming from the government. So the loans will enter repayment, and even if they didn't enter repayment, they would accrue interest. Now, if the borrower goes with this strategy of allowing the loans to enter repayment and enrolling in SAVE, chances are they would have a low dollar or $0 payment, but technically those loans would be in repayment. One of the features of SAVE is the elimination of what's called negative amortization. Negative amortization is what happens when a borrower's monthly payment is not sufficient to cover the amount of interest accruing in a month. So if there's a $50 payment required and there's $200 worth of interest accruing each month, that means that this person's balance is going to grow by $150 because their $50 payment is not enough to cover the $200 worth of interest that accrued during that month. Well, through SAVE, the borrower would not be held responsible for that extra $150. They would not see their balance grow anymore because the government would cover that excess interest. Also, the borrower being enrolled in SAVE could begin earning credit toward income-driven repayment while they're in school because they have opted out of the in-school deferment. They have enrolled in SAVE. And this would be the case even if they're making no payments because they have a $0 payment. Remember, with SAVE, as long as the borrower satisfies whatever their required payment is, the excess accrued interest would be covered by the government. The borrower would not be held responsible. So what the borrower in this situation is trying to do is get around interest, get around interest accruing by taking out plus loans because they can opt out of the in-school deferment, go straight into repayment, and then enroll in a plan that basically provides an interest subsidy. So as for whether a borrower should do this, my recommendation, as with all things, is you have to review all the factors and then make a decision that's based on your situation. This particular borrower is a full-time student. They are a part-time worker, and their level of income is low enough that they're likely to have either a very low monthly payment or a $0 payment while they're in school. The obvious benefit is the interest subsidy. If the borrower is able to opt out of that in-school deferment and enroll in SAVE, the government will pay any excess accrued interest after the borrower has satisfied their minimum payment. So if this is a borrower whose required payment is $0, this means that their loans will effectively not be accruing any interest the entire time that they are in school, as long as they've opted out of the in-school deferment and stayed enrolled in the SAVE repayment plan. Potential drawbacks, one is that SAVE is new, so we have no practical experience to draw from yet. I've heard about this, and I hear some people are doing it, but the first part of SAVE was just implemented this summer. The second part will be fully implemented, we expect, in summer of 2024. So we haven't seen anyone do this successfully yet. And that doesn't mean that it could not work. That just means that I cannot tell you, yes, you should do this because it will work. I don't know that. So I definitely would not tell you to do this with any assurance that it will work out the way that it should in theory. Um, Also, you have to opt out of the in-school deferment repeatedly. The in-school deferment is something that happens automatically because when you enroll in a certain amount of credits, your school reports to a clearinghouse. And if you're reported as being at halftime or greater, then your loans automatically go into the in-school deferment, and you have to opt out of that deferment. So for each term that you're in, you would have to, I'm not sure if it's each term. I know the clearinghouse reports each term. I believe you would have to report each term or contact your servicer and opt out each academic term if you want that in-school deferment to continue. This is something that I've got to say I'm not sure about, again, because I haven't seen this in real life. But I will definitely reach out to a couple of people who have opted out of the in-school deferment for different reasons. That was to earn credit toward PSLF while they were working full-time and going to school halftime. So I will see what I can find in the way of practical experience with the frequency of opting out of the in-school deferment. So all of this to say, this is not an easy thing for me to discuss because, again, I've seen no one go through this. And so I can't report back to you on, success rates and what the process was like. In theory, it should work, but in practice, we have no way of knowing how this works. And if you're doing it, I would be delighted to hear from you so that we can see how it pans out and be able to provide more information to people who are wondering about whether or not they should pursue this as a strategy. All right, so as for why someone would do this, I already mentioned this. The primary motivation is to avoid interest because SAVE provides a subsidy, and if they have a $0 payment, they basically have made it so that their Graduate Plus loans will not accrue any interest that the borrower will be responsible for the entire time that they're in school. Another reason could be to earn credit toward income-driven repayment cancellation. Quick note, financial aid administrators at your school may advise you to exhaust your direct unsubsidized loans first. And I will touch on that in answering the next question, but a lot of it has to do with interest rates. If you look at the chart here, you'll see loan types, borrower types, and the interest rates that are associated with the loans for this academic year. That's from July 1st of 2023 to June 30th of 2024 for the first disbursement date. So you'll see for direct subsidized loans and direct unsubsidized loans for undergraduate students, you'll see the lowest interest rate, 5.5%. That interest rate is set for the life of the loan once it's dispersed, but interest rates can fluctuate from year to year. So if you're having a disbursement this year, the rate is 5.5 for undergraduate loans. For next year, the rate will likely be different. For direct unsubsidized loans for graduate professional students, note, there are no direct subsidized loans for graduate or professional students. The only ones are direct unsubsidized loans or direct plus loans. With direct unsubsidized loans, they have a lower interest rate than plus loans. They're at 7.05%. The direct subsidized and unsubsidized loans also have lower origination fees. Then there's the direct plus loan. Plus loans are available for graduate professional students and for parents. They have a fixed interest rate of 8.05%. Plus loans are also the ones that do not have the mandatory in-school status, and that's what would allow this SAVE strategy to happen. So let's take a look at SAVE just for a refresher on what SAVE actually does and the big difference that it makes. The SAVE plan first increases the income exemption from 150% to 225% of the poverty line. And that part of SAVE has already been implemented. That basically just means that more of your income is protected from being treated as available to go towards your student loan payment each month. The second component is the one that I've discussed in answering this question, and that's that the plan eliminates 100% of remaining interest for both subsidized and unsubsidized loans after a scheduled payment is made under the plan. So as long as you make your required payment, Any excess interest that accrues would be covered by the federal government, and that is probably the largest selling point that I've heard about from people who are interested in applying for SAVE. It's, again, getting rid of the possibility of negative amortization. Also, the SAVE plan will exclude spousal income for borrowers who are married and filing separately. So your spouse's income would not be considered as available to go toward making your student loan payment. So these parts of SAVE have been implemented already. Next year, we will see SAVE go into effect fully, and there are a few other features that will become active. One is that payments on undergraduate student loans will be cut in half. Right now, SAVE uses 10% of your discretionary income, but next summer, for borrowers who have undergraduate loans only, that percentage will be cut to 5%. So for people with undergraduate loans only, their payments will be cut in half. If you have undergraduate and graduate school loans, then the rate will be somewhere between 5 and 10% based on a weighted average of your original principal balances. Also, borrowers who consolidate will not lose progress toward forgiveness. They're going to shift to a weighted average formula, a weighted average of the payments that counts toward forgiveness based upon the principal balance of the loans that are being consolidated. Also, at the end, it says borrowers who are 75 days late will be automatically enrolled in an income-driven repayment plan if they have agreed to allow the Department of Education to securely access their tax information. So none of the paper applications and providing, proof of income, if you can allow for that transfer to happen straight from the IRS. So SAVE is here, but SAVE is not 100% implemented. So for the person that's thinking about this strategy, I encourage you again to consider all of the factors that are involved, all of your options in terms of borrowing, and just being sure to account for the fact that SAVE is new. SAVE has not been implemented at 100%. And although in theory, this is a way around interest accruing while you're in graduate school, it's going to take some time for us to see how this really works. All right, and with that, I'll move on to our next question, which is in the same line of thinking, but this is coming from the perspective of a financial aid administrator. I'm an FAA, and a lot of my graduate students are requesting Graduate Plus loans instead of unsubsidized loans due to the SAVE repayment plan and flexibilities with in-school deferment. Should I promote this approach for my students? This, I know I say it a lot, but this is a loaded question. So financial aid administrators are trained to present options to students that are most favorable first. So when you have a financial aid offer and it has scholarships, grants, and different types of loans or work study, the order of acceptance that a financial aid officer or an administrator would likely tell you to accept in is always take the scholarships and grants first. Next would be federal work study, because these funds don't have to be repaid. After the scholarships, grants, and federal work study have been applied, whatever's left over, if you're not contributing any cash out of pocket, then you would go to loans. Within the category of loans, you would want to take direct subsidized loans if you are an undergraduate student. If you're a graduate student, you would take the direct unsubsidized loan first and then the Graduate Plus loan. So that's kind of like the pecking order of acceptances for financial aid. Now, when it comes to graduate students, the FAAs are trained to present the direct unsubsidized loan as a better option for a few reasons. One, we already saw from the previous slides. They have lower interest rates and lower origination fees. They also have an in-school status, which means the borrower is not required to make payments while they are in school at least half time. And lastly, direct unsubsidized loans do not require a credit check, whereas plus loans for graduate students do have a credit check. Many graduate students end up borrowing direct unsubsidized loans and plus loans because unsubsidized loans have limits. SAVE, though, provides an incentive, or at least in theory, it provides an incentive for choosing the PLUS loan over the direct unsubsidized loan, because there's that potential to opt out of the in-school deferment, allow the loans to go into repayment, enroll and save, satisfy the low or $0 payment, and allow the rest of the interest to be covered by the government. So if you're a financial aid administrator and a student comes to you with this, if they come to you with it, that means the student already knows and they're already thinking about this. And this is something that you want to make sure your office has a policy for and a consistent message, because students talk, and we want to make sure that they have the most accurate information possible, but you're also putting out a consistent message. You don't want to have two students come to the office, ask the same question, and leave with completely different answers. The choice of which loans to accept and the order of which to accept them in, that's up to the student. As a financial aid administrator, you can give them honest advice about the pros and cons of each. And unfortunately, this situation is a bit more difficult because we have not had the opportunity to see this, potential save loophole. We haven't had the opportunity to see this work out. So you can't tell a student, well, if you do this, then this will happen, because none of us have had the opportunity to observe this. So when you are coming up with, your policy and your messaging, I just wanted to share with you a few tips about what goes into crafting a well-rounded message for your students. The first thing is you want to be accurate. In this case, you have no practical experience to draw on, so you can share with them, for example, that the unsubsidized loan has an in-school status that cannot be avoided. Yes, the PLUS loan has an in-school deferment, which you can opt out of. These are facts, and you can present those to the student. The student can then, decide which path they'd like to pursue. You also want to make sure that you provide a holistic view of this. You can explain the differences between the unsubsidized loans and the PLUS loans. You can explain the fact that we have no practical examples to show that this loophole actually works, while there is, in theory, the opportunity for it to work. You can also explain that the in-school deferment is something that the student would likely have to opt out of on multiple occasions. And you can also explain to them what happens when a loan enters repayment, dealing with their servicer, enrolling in certain plans, the fact that SAVE will require them to provide documentation of their income. You can give them a holistic view of loan repayment, as well as, the limited information you have about this potential loophole. And again, the fact that we have no practical experience to point to with this. The last thing, though, I really want to suggest is making sure that you are inclusive, because when it comes to, loopholes like this, or any kind of strategy that provides some kind of favorable outcome that maybe not a lot of people know about, if you only share it with a student who comes in to ask you about it, that student's probably going to go and tell other students. But if you only share it when a student asks you about it, then it creates a situation where there's exclusivity, because that student comes in and it's not something that you necessarily want to, put a huge, you can't put a poster on your website, but you might not want to advertise this as an option. But if you tell one student, then it's not necessarily right to withhold that information from others. So if you want to be inclusive, I would definitely suggest crafting that policy and a message to be proactive about this. Because again, if one student comes in and they tell, the people that they know, but then other students are left out, and the information that they got came from the financial aid office, that's just not a good situation. That's fostering exclusivity. So while I can understand why no one would want to go about advertising this, because from the people that I've talked to, it might feel a bit shady, doing that, telling a student how to potentially get out of paying interest to the government. But it's very important that you provide information that is accurate, looks at the whole situation, and is available to everyone. So since I've heard this from several people, especially people who are working with medical school students, I would strongly suggest, and perhaps the center will create something about this that is not coming from a for-profit entity trying to sell students advice or promote that everybody should do this, but just an honest look at what it is. The word that's going around, the rules, the theory, what could happen in practice, and the fact that we haven't yet had the opportunity to see that. So you have a lot to consider if you're a financial aid administrator and you are, getting these questions from students. But just make sure that you have clear, consistent messaging, because the students are going to talk. You want to have at least prepare all of them to make an informed decision, but it's not your job to make the decision for them. You give them the information, you provide them with wise, unbiased, not-for-profit driven counsel, and then the decision is up to them. And I think that that's the best that you can do. All right. Next question, shifting gears a bit. I attended the Maryland Supplemental Retirement Plans workshop today with Dr. Kennedy. I'm curious about the Maryland Tax Credit for Student Loans program. I applied earlier this year and I'm wondering, if I receive the credit, are private or alternative loans eligible to use the payment for? Are there any limitations on the kinds of student debt it can be applied to? So, to answer the questions outright before I get into lots of details about the program, I didn't see anything on MHEC's website to say that the tax credit could not be used toward private or alternative loans. They cannot be used toward Parent Plus loans from what I read. Parent Plus loans were not excluded like in plain language, but the language said loans for your own education. So that tells me that Parent Plus loans are not included. So from what I took away, the tax credit can be used for federal student loans or private or alternative loans that you took out for your own education. And those are the only limitations that I'm aware of about the type of loans. But I did want to talk a bit about the Maryland Student Loan Debt Relief Tax Credit and how it works. So the tax credit application for this year, actually that window closed in September 15th, but it opens up again every year on July the 1st. The Maryland Student Loan Debt Relief Tax Credit provides an income tax credit for Maryland resident taxpayers who are making eligible undergraduate and/or graduate education loan payments on loans obtained to earn an undergraduate or graduate degree. They list the degrees there, and it has to be from an accredited college or university. As for who's eligible, you had to have borrowed at least $20,000, and at the time that you apply for the credit, you have to owe at least $5,000. As I mentioned before, the loans must be for your own education, and you have to provide documentation of the loans. So you got to provide proof of the loans at the time that you apply, and you can get that from your services online portal. You also have to have information from your state tax return in Maryland. That's Form 502. You also have to have transcripts from the schools that you attended when you borrowed the loans. They're included in your application, and it's okay if those transcripts are unofficial copies. You also have to provide proof of student loan payments made after you receive the tax credit. And the language from MHEC's website says that you have to submit that information within 3 years after the close of the taxable year for which the credit applies. And you would get that information from your services online portal. Now, for as long as I have applied for this tax credit, there's always been excess demand. So the tax credit, I believe, can be up to $5,000, but I'm not aware of a time that it's been that high because there have been so many people who have submitted applications for it. So it's usually been between $900 and I think about $1,200 or $1,300. But there are priority levels that are placed on applications. So priority is given to taxpayers who did not receive the tax credit in a prior year. You can get the credit more than once, but chances are you will not get it in back-to-back years. Priority is also given to taxpayers who are eligible for in-state tuition. Also, those who graduated from an institution of higher education located in Maryland, and those who have higher debt burden to income ratios. The income information would be viewed from your state tax return, and of course, the debt burden would be viewed within the proof of loans that you submit as documentation with your application for the tax credit. So in this past cycle, we've had some changes that were implemented. Additionally, additional priority levels were assigned. Priority was given to state employees. Priority is also given to graduates of certain schools that are listed. Many of them are community colleges and historically Black colleges and universities. Now, as for the application, I mentioned that the cycle for this year has closed, but it's an annual cycle that opens July 1st and runs through September 15th. The application is online at onestop.md.gov. There is a paper application, but the online application is preferred, and MHEC has said this. We've already been through the documentation that you need, but just as a quick recap, you'll need your unofficial transcripts, or official if you have them, your Maryland income tax return, and the proof of your loans, which you can get from your lender. Now, about the tax credit and how it works. The tax credit is not like a check. So let's say you get approved for the tax credit of $1,000, you will not receive a $1,000 check from MHEC in the mail or $1,000 direct deposit. It's a tax credit. So the way you receive it will be through your income tax refund, or if you owe, the credit will be applied so that you owe less. So if you receive the credit for $1,000 and you filed your taxes or preparing to file your taxes, and your refund before the credit is $2,000. If you're approved for the credit, that means your refund will go from $2,000 up to $3,000. Now, on the flip side, if it turns out that you owe $2,000, if you receive the tax credit, then you would only owe $1,000. But either way, there is no cash disbursement. The credit comes through either your refund, or by increasing your refund, or by lowering the amount that you owe after you have calculated your personal income taxes for the state of Maryland. Once you get the credit, you have 3 years from the close of the taxable year for which the credit applies to pay at least that same amount towards your student loan debt. And you have to provide proof of the payments to MHEC. So if you get the $1,000 tax credit, you have 3 years to take that $1,000, or over time, just another $1,000. You need to pay at least $1,000 toward the student loans. And then you need to provide proof that you paid the $1,000 in student loans to MHEC, so that MHEC can note that you satisfy the conditions of the tax credit. If you do not provide proof of those payments within the stated time, you will be required to return the money to the state through a process known as recapture. The recapture process is controlled by the comptroller, but basically they're going to take the money back. It's a clawback. You got the credit, and then you're going to have to give it back because you did not meet the condition to use that money toward paying down your student loans. Now, interestingly, we're coming out of this CARES Act Forbearance that was for more than 3.5 years. The CARES Act Forbearance, nor any other forbearance, alters the rules of the Maryland Student Loan Debt Relief Tax Credit. So if you received the credit and your loans were included in the payment pause, then you still have to make the payments within that 3-year period and provide proof that you made the payment. So for someone who received the tax credit, let's say in 2020, and they had to make the payment by the end of 2021, 22. By the end of that 2022, if they had to make the payment, technically their lender would not have required them to make a payment if their loans were included in the CARES Act Forbearance. But even if the lender did not require them to make a payment, if they got this tax credit, MHEC requires them, or the state of Maryland, I should say, requires them to make that payment because that's a condition of receiving the tax credit. So the CARES Act Forbearance, that's a federal issue. It has no bearing on whether a resident of Maryland would be able to change that required payment. That's a condition of receiving the student loan debt relief tax credit. So you have to make it regardless of whether your loans were included in a CARES Act forbearance or if your loans were in a forbearance of your own choosing. You still have to make the payments. So this is just a chart that shows the year. So the tax credit awarded year, if you received it for the award year of 2020, then you have to submit your proof of payment by December 31st of 2023. Now, I remember I received the tax credit in the award year of 2019. So I had to submit proof of my payment by the end of last year. And that was a time where, we were during the COVID, the CARES Act forbearance, which sometimes people refer to as the COVID-19 payment pause. So I received the tax credit. I was not required to make any payments according to my lender because my loans were in the CARES Act forbearance. But for the state, I had to make a payment. So I did. I made a lump sum payment, and then I sent proof of that payment to MHEC, and they sent me a correspondence back to say that I had satisfied the requirements of the tax credit. Also, a quick note about the tax credit. When you file your taxes, you'll be asked to include the notification from the state of Maryland. It's been a couple of years or a few years since I received the credits. So I'm not sure that the process works exactly the same, but there's a letter that was sent to me via email, and it just explained that I was receiving the tax credit in the amount of X dollars, and that I needed to submit this letter with my taxes, with my personal income tax return to the state so that they would know to apply the tax credit. So big things to remember. One, you're not getting cash. There will be no check dispersed. The tax credit will be received by either increasing the amount of your refund or decreasing the amount that you owe on your personal income taxes. Two, you are required by the state to make a payment for at least the amount of the tax credit according to this chart here. Depending on your award year, you see the deadline that you have to provide proof of payment by. And third, if you are approved for the tax credit, just you'll know by receiving an email from MHEC. So be on the lookout for that. It will include the letter that you'll need to submit as documentation with your state income tax return. When I filed, that attachment could not be submitted electronically. So I had to paper file my state taxes. I'm not sure if that process is the same at this point because it's been a few years, but you have to provide proof that you have been approved for the tax credit so that the state will go ahead and process it for you. All right, so not a lot of questions, but definitely a lot of information. At this point, I'm going to wrap things up by providing some options for accountability for those of you that would like to submit complaints about your student loan lender or servicer. You can always go to the Consumer Financial Protection Bureau where lending products are concerned. You can visit them online at consumerfinance.gov/complaint, and the address is in the chat section. You can also file a complaint with the U.S. Department of Education's Ombudsman's Office if you look at the kind of screener on their website and find that your problem meets the criteria for an issue that rises to the level of their involvement. If you have a specific request about your application for PSLF because the number looks too low and you've already gone to MOHELA.com and looked at the payment tracker and you see that you've submitted everything, but for some reason the payment count looks off and you have not been able to get an answer about resolution from MOHELA, then I would encourage you to submit that PSLF reconsideration request. Not as a first stop, but something that you do after you have tried MOHELA and after you have verified that you submitted everything you needed to, And if you just consolidated, you've given it several weeks to get an accurate count. Also, the state of Maryland is a state that has a student loan ombudsman. The student loan ombudsman can assist with problems that you may be experiencing with your student loan servicer, which include failure by the borrower to communicate with the borrower, failure by the servicer to communicate with the borrower, errors in crediting principal and interest payments, misapplied payments, inaccurate interest rate calculations, billing errors, loan consolidation and or modification errors, and or inappropriate collection activity or tactics. And if you'd like to get in touch with the Student Loan Ombudsman's office to file a complaint, you can visit them online through the state's Department of Labor, and the link is in the chat. Maryland is also a state that has a student loan borrower's Bill of Rights. You can take a look at that Bill of Rights again by visiting the Ombudsman online at the state's Department of Labor, and there you can learn about the protections to which Maryland borrowers are entitled and the obligations of student loan servicers. Again, the addresses for the complaint and the complaint filing window and for the student loan borrower's Bill of Rights are all through the Department of Labor, and they are in the chat. So at this time, I would like to thank you so much for joining us for another edition of Office Hours. My name is Dr. Tisa Silver Kennedy. I am the founder and executive director of the Maryland Center for Collegiate Financial Wellness. As always, you can keep up with us online. We are on social media, Instagram, Facebook, X, and YouTube as at the MCCFW. Again, that's at the MCCFW. Thank you to those of you who have subscribed. We really appreciate you. And if you haven't subscribed, but you continue to engage with the content, like the videos and leave comments, we appreciate all of that too, because that just helps us to reach more people and to also learn more about the concerns that borrowers are dealing with. You can also visit us online at mccfw.org and find out what's going on with our program, support if you would like to, and register for our upcoming events. I did want to take a look at one question. Give me one moment while I find it. I'll stop sharing while I look at this comment. Okay, so the comment is actually on our YouTube page, and the comment is, I have heard from multiple people that they were advised by their counselors to go into a forbearance versus doing a consolidation. What would be the reasoning for doing forbearance and not consolidating? Well, let's talk about what those two things mean. So a forbearance is a pause in student loan payments. When you put your loans into a forbearance, that means that the structure of the loans is not changing, the balance, all of that stuff. The loans remain the same. It's just that payments are not required. And in a normal forbearance, I'm referring to forbearances that are not like the CARES Act forbearance, because that was an unusual forbearance. A normal forbearance is requested by the borrower, and a forbearance means that you don't have to make a payment. However, interest is still accruing. So the debt becomes more expensive because you're not making payments and interest is accruing the whole time. Consolidation is different because with consolidation, you're actually changing the structure of the loans. The existing loans will be paid off and a new loan will be created that combines those existing loans. So the old loans are paid off, a new loan is dispersed. Since a new loan is dispersed, you have to fill out a new promissory note. You also have to select a repayment plan because this is a new loan. So a forbearance and a consolidation, those are two totally different things. I think that whether someone goes into forbearance or consolidates depends on a few things, and you could also go and consolidate and then go into a forbearance. So it really depends on what's the purpose. If the purpose of pausing payments is because a person can't afford to make them, then a forbearance would be a simple way to get a pause on payments. However, a consolidation could prove to be more strategic, because there are some people who have loans that have varying lengths of repayment history. And if they consolidate those before December 31st of this year, or by December 31st of this year, then all of those loans can be brought onto the same repayment clock as the loan with the most history in that group of loans that they're consolidating. So like I said, consolidation is more of a strategy right now during this IDR adjustment period for people to gain as much credit as possible toward both income-driven repayment and public service loan forgiveness if they have the qualifying employment. So I cannot think right now of a situation where I would advise someone to go into a forbearance versus the consolidation if the IDR adjustment is something that they are looking to take advantage of. If someone's having difficulty making payments, then yes, like I said, forbearance is an option because the payments will be paused. But in the larger scheme of things, if the IDR adjustment could benefit them, if they're looking at public service loan forgiveness, they could consolidate those loans, get on track for both the IDR adjustment and PSLF, and make sure they complete that application by December 31st of this year. And if after the consolidation is completed, they still are unable to make their payments, then they can go ahead and request a forbearance. I would not request a forbearance if they have not explored income-driven repayment first. IDR could provide them with a payment that's affordable, and they would continue to earn credit toward the IDR adjustment and PSLF if they have the qualifying employment. So all of that to say, I'm going to reply to that comment and ask for a bit more clarity because forbearance is just strictly if you can't afford to make payments, there's no way around that difficulty to repay, then a forbearance is a pause. Consolidation is different from forbearance because you're restructuring those loans. And until the end of this year, a lot of people are doing that so that they can gain as much credit as possible toward the IDR adjustment and PSLF. A forbearance isn't going to get you credit toward anything under normal circumstances. Okay. All right. Let me check and see if we have any other questions that have been submitted, questions or comments tonight. All right. I think we have covered all the questions that have been submitted. All right. And I think we're good to go. We are 2 minutes over. Pardon me going over time, but thank you again for joining us for this, the November 8th edition of Office Hours. Again, I'm Dr. Tisa Silver-Kennedy, founder and executive director of the Maryland Center for Collegiate Financial Wellness. Please do visit us online at mccfw.org/contact. If you think of any questions that come up between now and the next edition of Office Hours, we will make sure that we answer your question and might even make a video about it.